We had a situation in the 1970s that was a very odd recession. It was stagflation, which is to say you had an economic slowdown that was accompanied by inflation too. Normally, recessions are caused by higher interest rates. In this circumstance, the recession was both a cause and an effect of the higher interest rates. That was a really interesting circumstance that I'm afraid we're doomed to repeat. The part of that assertion that I think is particularly relevant to today is that in the decade of the 70s, the absolute purchasing power of the US dollar, which is to say its performance against itself as opposed to some other currency, was that the dollar lost 75% of its purchasing power. It's not coincidental that in that circumstance, the gold price went up. The gold price held, or more than held, its own purchasing power. If we look back at the decade of the 70s, and we put on one side the 75% decline in purchasing power, and we put on the other side the 30-fold increase in the gold price, I think we can roughly dissect that. Not exactly. The move from $35 an ounce to, say, $100 an ounce was mostly a function, I think, of the end of price controls on gold, which is to say it was a coiled spring. When in this country it was at $35 an ounce, there was a gray market for gold internationally between 42 and 45. When the price cap came off in the United States and American demand met world demand, the price went from 35 to 100. The price began to, it is arguable, overshoot in 1974 into early 1975 when the gold price went from $100 an ounce to $200 an ounce. At that point in time, there was broad spread concern about inflation. Everybody wore these whip inflation now badges. Nobody did anything about it, but they wore badges. But Congress did something about it. They raised the interest rate. Well, the market raised the interest rate, and Congress and the Fed followed through. Fairly dramatic increase in the interest rate. That did two things. Well, three things, really. It tanked the bond market. It already hurt equities markets, and it obliterated the gold market. In 1975, the gold price declined from $200 an ounce, to $100 an ounce. Towards the end of 1975, looking at the bond market, looking at the housing market, looking at the equities market, the U.S. government blinked twice and reduced the interest rate. When that happened, investors understood what was happening. The game was on. And the gold price went from $100 an ounce to $850 an ounce in 6 short years. My suspicion is that past is prologue. Now, remember that at $850 an ounce, what you had was a circumstance where gold was overbought. Gold went from being unloved to being the only game in town. So I would suggest to you, in the context of today's discussion, that the real price of gold in the decade of the 1970s, before the overshoots, probably ran fourfold. In other words, the US dollar declined by 75%, and the nominal price of gold, probably mirrored that fall, probably went up fourfold. The move from, say, 400, 450 to 850, I think probably had to do with piling on. I think it had to do with people coming into a trade that had already established itself. We know that mean reversion is usually accompanied by overshoots. And my suspicion is that happened in the 1970s, and my suspicion is it may happen again. I believe in the period 2025 to 2035, that is to say the next 10 years, the US dollar probably loses 75% of its absolute purchasing power. Not its purchasing power relative to the Swiss franc or the euro or the Canadian dollar or the renminbi. I'm not talking about that. I'm saying for US dollar denominated spending, that the US dollar loses 75% of its purchasing power. And my belief is that it is likely, not certain, that gold mirrors that, which is to say that gold goes up in commensurate fashion with the purchasing power of the US dollar going down. Is this a trade that somebody should put their whole net worth in? Of course not. This is a contingency worth insuring. That's what it is.
If history is the teacher it often claims to be, then the decade we're entering, 2025 through 2035, might look hauntingly familiar to anyone who remembers the 1970s. Back then, we had what economists call a stagflationary recession. And frankly, I think we're about to see a rhyme of that same tune. Let's remember what made the 1970s so odd. You had inflation running hot, and at the same time, you had a stagnant economy, rising prices with falling real output. And that's not supposed to happen, right? Traditional theory says higher interest rates slow down inflation, but they also cause recessions. Yet in the 70s, inflation itself fed the recession, And the recession fed even higher interest rates. It was a loop, a mess, and monetary authorities were completely outmatched. I'm not here to scare you. I'm here to tell you that what happened back then is not just relevant, it's predictive. The absolute purchasing power of the US dollar, not relative to other currencies but to itself, meaning what it could buy in real goods, collapsed by 75% during that decade. And what happened to gold? Well, gold didn't just maintain its purchasing power, it exploded. From $35 an ounce to $850 by 1980. That's not a typo. That's a 24-fold increase. Now sure, the entire move wasn't fundamental. I'm not claiming every dollar of that price rise was rational or sustainable. But let's dissect it a little. The move from $35 to $100 an ounce was mostly structural. It reflected the end of government-imposed price controls. There had been a cap on gold for decades, a sort of financial lid keeping the pressure from showing. But the rest of the world was already trading gold in a gray market at around $42 to $45. So when the lid came off and American demand was allowed to meet global demand, the price naturally shot up. What happened next was a mix of panic and momentum. The market took gold from $100 to $200 very quickly in 1974 to 1975. You had inflation fears everywhere. People were wearing WIN badges, remember that? Whip inflation now. That was the government's best idea. Not fiscal responsibility, not monetary restraint, badges. Eventually, of course, the Fed did something meaningful. Interest rates shot up. That crushed the bond market. It crushed housing. It crushed equities. And it crushed gold for a moment. Gold dropped from $200 to $100 again by the end of 1975. People declared the gold bull dead. Sound familiar? Well, the government blinked, as they always do. The markets were bleeding. The pressure was unbearable. So they started cutting rates again. And that was it. The game was on. Gold took off. From $100 to $850 in just 6 years. No internet, no ETFs, no Reddit. Just investors watching policy, watching debasement, and acting accordingly. Now let me fast forward you to today. What if I told you the same setup is happening again? We've got rising inflation, a confused central bank, ballooning deficits, and a public that's losing faith in the currency. Not because of what it does on Forex markets, but because of what it buys at the grocery store. That's what matters. Not whether the dollar is strong versus the euro or the yen, but whether your dollar buys the same basket of goods it did last year or 5 years ago. Spoiler alert, it doesn't. I believe the US dollar is once again on track to lose 75% of its purchasing power, not overnight, but over the next decade. From 2025 to 2035, we are likely to witness another long, slow grind, lower in the real-world utility of our currency. Now, before anyone panics, let's clarify. I'm not talking about total collapse. I'm not saying the dollar goes to zero. I'm saying it does what it did in the 70s. It weakens, steadily, predictably, painfully. And in that kind of environment, the only rational response is to own something that doesn't rely on anyone's promise. Enter gold. Now, I'm not saying gold goes back to $35 and makes the same 24-fold move. Don't misquote me. What I'm saying is that if the dollar's purchasing power declines by 75%, gold will likely rise by an equivalent magnitude. Think of it this way. If your dollars lose value, gold doesn't have to do anything. It simply reflects that reality. It's a mirror, a signal, not a trade. That's the mistake most people make. They look at gold like a stock, like they're timing an entry and an exit. That's not what gold is. Gold is an insurance policy. It's what you own so that when policymakers lose control, you don't. You see, markets tend to revert to the mean, but reversion is rarely neat. There are overshoots. Think about the 1970s again. Gold probably should have gone from $35 to $400, maybe $450. That would have roughly mirrored the 75% decline in the dollar. But it didn't stop there. It hit $850. Why? Because once the move becomes obvious, people pile in. Fear kicks in. Momentum takes over. And you overshoot. We saw the same thing with Bitcoin in 2021. We saw it with tech stocks in 2000. And I believe we'll see it with gold again. Not because gold is speculative, but because the failure of fiat currency is no longer theoretical. It's being lived.
I think the gold-silver ratio is a factoid. I think it's important only because the market thinks it's important. Think this through. People say that the ratio should be 16-1, which reflects the relative abundance or scarcity of both commodities in the Earth's surface, relative to 100-1, which is the price differential. But why should price be a function necessarily of supply or scarcity when it doesn't consider utility and it doesn't consider cost of production? With silver, as an example, about 18% of the world's supply of silver comes from silver mines. The rest comes as a byproduct of mining other metals or as a consequence of recycling. What that means is that the production cost around silver is a minor impact, a minor part of the supply-demand equation. Look, too, at the massive above-ground holdings of silver in private hands. Most of the gold that's held publicly is held in public hands, which is to say in government hands. But silver is controlled in private hands, which makes it much more difficult to measure. In my experience, industrial supply and demand in silver has been interesting, but the quantum moves that we've seen in the silver market, the moves from $4 to $50, or in the 70s from $1.20 to $50, have come as a consequence of overwhelming investment demand. That's happened 3 times in my life. I've seen better than tenfold moves in silver bullion 3 times in my life, and none of them accompanied increases in industrial materials markets. My experience has been that precious metals bull markets are led by gold. Eventually, and we're seeing that right now, leadership changes from the bullion to the highest quality gold stocks. Later, leadership changes to the mid-tier gold stocks. When the momentum in the precious metals markets lends credence to the precious metals narrative, and the generalist investor comes into the precious metal space, perhaps because of silver's lower unit cost, making it more affordable, or perhaps because of its reputation for upside volatility, or perhaps both, the generalist investor, particularly the speculator, becomes attracted to silver. And the leadership in the market changes from gold to silver. Steve, when that happens, you won't need Rick Rule to tell you what's happening. It will be very dramatic. It will be very, very, very apparent. But I'd pay less attention to the gold-silver ratio, and I'd even pay less attention to the utility generated by silver in the industrial market. And I would pay much more attention to the traditional dynamics around investor and speculative demand in precious metals markets and the history of the price action in those markets. Well, I would say that from the tier 1 boot camp, 100 million ounces of silver probably puts you in strong tier 2.
Okay.
Understand that we want minimally $10 million in in-situ recoverable reserves and resources, but we would prefer $20 billion in in-situ recoverable reserves and resources. Now, big silver deposits, well, in fact, economic silver deposits are extremely rare. So speculators can be a little more generous in the silver side.
Let me paint a picture for you. It's 2028. Inflation is running at 5%, but the Fed has capped rates at 3%, because the debt service is choking the federal budget. Your savings are effectively losing 2% a year, compounded. Meanwhile, the S&P 500 is bouncing sideways because corporate profits are being eaten alive by higher costs. Bonds are a joke. Cash is a melting ice cube. And somewhere in that environment, gold is quietly revaluing. Not because it's moving, but because everything else is sinking. This is not some science fiction scenario. This is precisely what happened in the 1970s. Investors who lived through it will remember. First, they laughed at gold. Then they ignored it. Then they chased it. And let me be honest, it won't feel good when gold makes its real move. It'll happen because things are going wrong. You'll hear people say, gold is spiking. Something must be broken. And they'll be right. The system will be breaking. That's the very point. When gold hit $850 in January 1980, it wasn't a celebration. It was a warning. It was a signal that confidence had collapsed. It was a fever chart of public trust in the monetary system. And if we're honest, we're heading in that direction again. The good news is that you don't have to panic. You don't have to time it perfectly. You just have to be early. The crowd will come late, as it always does. But you don't have to. Let me throw in something you may not hear from other gold advocates. Gold isn't enough, not in isolation. What you really need is a framework. You need to think like a capital allocator. You need optionality. You need liquidity. You need patience. If you're going to survive the next 10 years, not just endure it, but emerge stronger, you need to build a portfolio that makes sense for a world in transition. That means real assets, not just gold, but energy, agriculture, water, land, productive enterprises, companies with pricing power, low debt, real margins. Hard money, gold, silver, and in some cases, sound digital assets, if you understand the risks. I'll say it again. I'm not anti-dollar. I've lived my life in dollar-denominated systems. I'm not some gold bug in a bunker with canned food and ammo. But I am a realist, and realism means acknowledging that the system we're in is unstable. In the 1970s, we had a roadmap. We had gold as an escape hatch, and people used it. The same opportunity is available now, but this time it's global. This time you've got central banks from the East, China, Russia, Turkey, Kazakhstan, accumulating gold like it's a race. And maybe it is. They're preparing for a post-dollar world, not tomorrow, but soon. They see the writing on the wall. They see the deficits. They see the weaponization of the dollar. They know that trust, once lost, is hard to recover. And trust is what fiat currency is. It's not backed by anything but confidence. Confidence in the issuer, confidence in the system, confidence in future repayment. What happens when that confidence erodes? You get what we had in the 1970s. You get what Argentina has lived with for decades. You get what's now brewing in Japan and the Eurozone. You get an era where people stop asking, "What's my return on capital?" and start asking, "What's my return of capital?" That's where gold shines. Gold doesn't default. It doesn't get hacked. It doesn't dilute. It doesn't go bankrupt. It just is. It sits there, quietly preserving value across time and space. So let me bring this home. From 2025 to 2035, I believe we will see a 75% decline in the dollar's purchasing power, persistent, sticky inflation that undermines real returns, rising political instability and fiscal dysfunction, a revaluation of gold, not because it changes, but because the system around it does. And I believe gold will reflect that revaluation with a price several multiples higher than where we are today. Not as a speculative moonshot, not because gold is going to the moon, but because the dollar is going to where fiat currencies always go, down. Should you put everything into gold? Number. That's not wise. But should you own enough to ensure your purchasing power, to hedge your long-term risk, to sleep at night? Absolutely. The old saying still holds, it's better to be a year early than a day late. Gold doesn't care when you buy it, but when the reset comes, you'll wish you had. I've said it for years, you don't buy gold to get rich. You buy gold so that your wealth doesn't evaporate in the fog of monetary mismanagement. Because trust me, the fog is thick. And as we've seen before, once that fog lifts, it's already too late to act. Now here's something else that's rarely discussed. The role of gold as political leverage. Ask yourself why nations like Russia and China are stockpiling gold. Not just as a reserve asset, but as strategic collateral. If sanctions cut you off from dollar trade, how do you transact? You don't wire dollars, you move bullion. That's how trust is rebuilt in a fractured world, through something real. Gold isn't just a hedge against inflation. It's a hedge against institutional decay. It's a hedge against weaponized finance. And that's what makes it uniquely valuable in today's geopolitical landscape. Even the IMF has quietly acknowledged that we're undergoing a monetary reset. They've stopped short of declaring a new gold standard, but the writing is on the wall. A multi-currency reserve world is emerging. The dollar will still exist, but it may no longer dominate. In that world, gold isn't a relic. It's a benchmark, a reference point, an anchor. It might not be legal tender at Starbucks, but it will be the final backstop of trust between nations and institutions that no longer believe in promises alone. So again, I ask you, how much of your portfolio reflects that future? Because your 60-40 stock bond portfolio, that's a relic. That worked in a world where rates fell for 40 years and credit expansion was your friend. That world is over. Now we're in a world where debt is a liability, not an asset, where bonds lose you purchasing power, where stocks tread water, and where gold just works. That's not speculation. That's math. So to those of you listening today, whether you're an investor, a saver, or just someone trying to navigate the coming decade with your head above water, ask yourself, what will matter most when the lights flicker? Not your yield, not your growth projections, your purchasing power. And there's nothing that protects that more consistently across centuries, across civilizations, across resets, than gold. Don't wait for the headlines. Don't wait for the panic. Because by the time the crowd rushes in, the trade will be over. The shelves will be empty. The premiums will be ridiculous. And the value proposition will have already moved. You've got time, but not much. Own gold, own silver, own things that are real. Because reality has a way of catching up, whether we're ready or not.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.